Another tome, another novel in the last week. Hello and welcome to the Northern Miner Podcast. A big happy new year. My name's Adrian Pocobelli. 2026 starting with a bang. You know what it reminds me of? Remember in 2020 when the Iranian general was taken out at the very beginning of the year? Kind of reminds me of that. Of course, we know what happened next. The market continued to go up in February. And everybody was kind of amazed, and you started to see almost a capitulation from the bears in February of 2020. And sure enough, March came along and a completely different story. It's quite interesting. We look at the metals. This rip-roaring bull market is broadening, and there are a few standouts. First of all, copper is at a record. I saw $6.09 on CNBC's page there, which are the copper futures. Silver and gold continue to climb back quite healthily. We look on the CNBC futures. Gold is trading at $4,458.40 per ounce. Silver at $77.48 per ounce. And this is on the March 2026 COMEX futures. Other huge standouts. Nickel at $7.84 per pound. We're seeing big moves here. And lithium at $17.11 per kilogram. So lots going on here. A new record in copper. Record copper price signals accelerating race for supplies. Kind of a panicky headline from Reuters, isn't it? An accelerating race for supplies. Let's take a look. Copper prices soared to records above $13,000 a metric ton on Monday, driven by fears of shortages and expectations turmoil in Venezuela could accelerate the broader race to secure critical minerals. Expectations of strong demand growth from data centers needed for artificial intelligence and electric vehicles helped fuel a 40% increase last year in prices of the metal used to make power cables. And we have a quote from SP Angel analyst John Mayer. Quote, copper prices need to rise further to persuade miners to generate significant new production. Many existing mines have been run at or well beyond their initial design capacity for many years, raising the risk of catastrophic failure as seen with the mud rush failure at Grasberg in Indonesia. End quote. While Venezuela is not known to produce refined copper, U.S. President Donald Trump putting the country under temporary American control after the U.S. captured President Nicolas Maduro has also highlighted risks to the security of supply of critical minerals generally. Quote, metals, copper included, are rallying on the thematics of critical minerals and security of supply chains in the New World Order, which comes into yet sharper view through latest events in Venezuela, said Duncan Hobbs, research director at Concord Resources. So quite interesting to see how these stories factor into each other. You know, it's a big deal if gold goes up. It's no small matter. If silver goes up, it's no small matter. This is a very big deal. But if copper goes up, this is a gigantic deal. This is an industrial metal, right? This is an industrial metal, and yes, silver is an industrial metal, but copper is far more commonly used. Now, we have another industrial metal making headlines. Aluminum price hits $3,000 for first time since 2022 on supply concern. This is Bloomberg News via mining.com. So it's not only Reuters that has these kind of, and I don't say this in a negative sense, but having a mildly panicky headline. Supply concerns. Reuters, an accelerating race for supplies for copper. Bloomberg, supply concern for aluminum. And what's interesting is I don't think they're being sensationalistic about it, as sensational as these headlines are. Let's take a look. Aluminum climbed above $3,000 a ton for the first time in more than 3 years on a tightening supply outlook and long-term demand bets, joining other base metals notching recent milestones. So here's the question that lurks here. Again, if gold goes up, okay, central banks have to pay more. Your investments, you might need to pay more. But your food at the grocery store or going to the hardware store or buying a car is not necessarily going to be hugely impacted by the price of gold, at least directly, perhaps indirectly over time. But on the direct and immediate sense, let's say not so much. If industrial metals start getting expensive and start having the same kind of move that we've seen in gold and silver, which is not at all crazy, you know, what if they go up 2 to 3x? And we may only be in the opening innings of this bull market. Let's call it the third or fourth inning. Let's say. What does that mean? What if copper ends up going 3 or 4x, or has been discussed in the past going up 10x? What does that mean for inflation? Like, what does that mean? Now, the final piece of this puzzle, before we continue, is the oil price. Oil's been, you might say, pretty low, below $60 a barrel. Let's take a quick look here on CNBC. Oil is at $58.43 per barrel. West Texas Intermediate and Brent crude, the international oil price is at $61.92 per barrel. Up 5 or 10% in the last couple of weeks. What happens if we have a breakout in oil? Rick Rule loves oil. You know, as he said, this is one of the biggest no-brainers for the next 5 years that he's ever seen. Rick Rule is a pretty good prognosticator. You know, and are we going to lower rates now at the Federal Reserve? But at the same time, let's say you have huge inflation. Maybe that's good for the U.S. Maybe that's good for all those huge debts. If you're the government, maybe it's a good news story. I don't know what it means for the consumer, though. I don't know what it means for you and me. Aluminum climbed above $3,000 a ton for the first time in more than 3 years on a tightening supply outlook and long-term demand bets, joining other base metals notching recent milestones. A cap on Chinese smelting capacity and constraints to European production due to higher electricity prices, hello energy, have chipped away at global inventories, while the demand outlook from the construction and renewable sectors remains robust. Futures rallied 17% last year, the most since 2021. Again, I'm kind of back to, it's one thing if gold and silver go higher. It's another thing if copper and aluminum go higher. Just look around you. How much gold and silver is being used? Look around you and ask yourself, how much copper and aluminum do you see? It continues. Copper also resumed gains Friday after capping the biggest annual gain since 2009 on tight supply, while nickel jumped after PT Vale Indonesia halted mining, allowing a delayed approval to a work plan from authorities. And we will come across this story shortly. The company said the approval is expected soon and the delay is unlikely to impact overall operational sustainability. Delays are not unusual in the Southeast Asian nation, but traders are honing in on supply after Indonesia said it planned to cut output this year. Copper hit a series of all-time highs during an end-of-year surge, making it the best performer of the 6 industrial metals on the London Metal Exchange. Mines in Indonesia to Chile and the Democratic Republic of Congo suffered accidents in 2025, while tariff concerns led traders to ramp up shipments to the United States. The main union at a Capstone Copper-operated mine in northern Chile began a strike Friday as members pushed for a bigger share of the windfall from the record prices. Continuing on, silver price. Here's what to watch after the wild ride past $80. So this came out just after last week's show, where I was discussing, waiting for the smoke to clear. Silver's exceptional volatility in recent days has captured the zeitgeist, with even the likes of Elon Musk drawing attention to the metal's ferocious rally to all-time highs. The metal rose to a record above $84 an ounce early Monday before promptly crashing to $70 in thin post-holiday trading. It was one of silver's largest price reversals ever. And then they talk about Chinese buying. Surging investor interest in China has been a key driver of silver prices in recent days. Speculators piled into the precious metal, mirroring a similar dynamic playing out in platinum. Elevated buying in the Shanghai Gold Exchange's silver contract in December has pushed premiums to a record high, dragging other international benchmarks along. So this discussion we were hearing last week is now being reported on in Bloomberg, pinpointing the source of the drive higher in silver with the Shanghai Gold Exchange. Very interesting. The blistering rally provoked the country's only pure-play silver fund to turn away new customers last week after repeated risk warnings went unheeded. The fund's manager announced the unusual step Friday after multiple actions, from tighter trading rules to cautionary advice about unsustainable gains, failed to quell an eruption of interest fueled by social media. Holdings in physical-backed silver exchange-traded funds have surged this year, rising by more than 150 million ounces. The total amount of metal held by the funds is still below a peak set during a Reddit-driven retail investment surge in 2021, but the inflows have been instrumental in eroding available supplies in an already tight market. Holdings in the funds have risen every month but one this year, according to Bloomberg calculations. And then it talks about how there is an options frenzy and how it is catching up with gold. And of course, the CME, as we discussed last week, it hiked margin requirements, which resulted in big volatility and a drop in the price. They did it at least twice. I thought I saw 3 times online, but the only story I see is December 31st, CME hikes precious metal margins again after price swings. This Bloomberg News via mining.com on December 31st. CME Group raised margin requirements on precious metal futures for the second time in the space of a week, following a bout of volatility that saw prices spike, then retreat. The higher collateral that traders must set aside to hold futures positions in gold, silver, platinum, and palladium is the latest evidence of a historic year-end surge in volatility across precious metals markets. Silver in particular has seen huge price swings as it blew through levels that until recently seemed unthinkable. The latest changes will take effect after the close of business on Wednesday, so that was last week. So we look at where we are, $77.67 on the CNBC futures, so quite a head-turning recovery here. Should be interesting to see what happens in silver. One would think there'd be a bit of a longer or bigger correction in store. I guess we'll see what happens. Now, another interesting dynamic is this story that came out of Bloomberg via mining.com. China's LONGi, which is a green energy company, joined solar push to cut costs by using less silver. So because silver is going up in price, the solar cell manufacturers are now reducing the amount of silver they're putting into their products. And this came out January 5th. LONGi Green Energy Technology will begin substituting base metals for silver in its solar cells, the latest move by the industry to mitigate the surging cost of using the precious metal. Mass production using base metals is expected to start in the second quarter, which will help further lower the costs of solar modules, LONGi said in a filing on Monday. The shift comes as manufacturers struggle with intense competition and steep losses. Record-high silver prices, fueled by strong haven demand amid geopolitical tensions and interest rate cuts by the Federal Reserve, have only accelerated the process. Other Chinese solar manufacturers taking a similar approach include Jinko Solar, which said in December it could achieve large-scale output of panels this year that use base metals such as copper. Shanghai Eiko Solar Energy, a smaller rival, has already launched production of silver-free solar cells with initial capacity at 6.5 gigawatts. So, it's going to be interesting to see. I mean, if this happens across industry, of course, silver is considered a better conductor than copper, but copper, I guess, works. But what does that mean for the copper price? Continuing on, another major industrial metal showing strength. Iron ore price nears best close since November on November year-end rally. And this is Bloomberg News via mining.com. Iron ore futures were set for their highest close since late November, riding a broader year-end rally in metals as traders look ahead to potential policy support from Beijing. I'm kind of back to Jeffrey Christian here. This increasingly is just looking like a bull market in real things. The steelmaking ingredient advanced for a third straight session in Singapore, climbing nearly 1.8% to as much as $106.55 a ton in intraday trading. In China, iron ore on the Dalian Commodity Exchange rose for a second day, gaining as much as 2.6%, the largest intraday rise since September 9th. The rally comes amid a broader surge across metals, with copper hitting an all-time high and silver smashing past $80 an ounce for the first time. Market sentiment was also boosted by China's latest call to support resource-based industries as part of its so-called supply-side reform program. The National Development and Reform Commission said Friday it would deepen these reforms in steel, petrochemicals, and similar sectors as part of China's 15th five-year plan from 2026. This would include the expansion of high-end production while prohibiting unauthorized capacity additions and using market mechanisms to encourage consolidation, it said. Now, we also have a related story in iron ore. This is from Reuters on December 29th, and we've been hearing this story of BHP having issues with shipping their iron ore to China. It seems to be continuing inside Beijing's bid to tame the global iron ore market. This by Melanie Burton at Reuters on December 29th. And interestingly, we were hearing earlier, as part of those negotiations, that China wanted to be able to use the yuan in buying this iron ore. However, it is not mentioned in this article China's state iron ore buyer is using increasingly hardball tactics against mining giants such as BHP to tighten its grip on the $132 billion seaborne market and extract better terms for steel mills, just as a giant new source of supply is set to strengthen its hand. And what imagines that is from Simandou, China's Mineral Resource Group, or CMRG, in November asked its steel mills and traders not to buy spot cargoes of second BHP product that drew concern from Australia's Prime Minister. The standoff over a deal for next year's supply marked an escalation because CMRG had not previously banned multiple products from a single supplier, traders and analysts said. That underscores how far the 3-year-old buyer is willing to go to wrest better terms for China's steel industry. The deal under negotiation will account for the lion's share of production from BHP's mines in Australia's northwest and around a fifth of China's needs. Reuters interviews with more than 36 steel and mining executives, traders, and analysts suggested CMRG has become more assertive, but found limited success. Some steelmakers have privately complained it has not delivered the better prices or contract terms they were seeking. So kind of mysterious as far as what those terms are. Still, CMRG's tactics with BHP could set a precedent for deals with Rio Tinto, Fortescue, and Brazil's Vale, said RBC analyst Can Pecker in Sydney, as China looks to cut its 80% margins the iron ore miners have historically enjoyed. Those are pretty big margins, aren't they? 80%. So no mention of Chinese currency, interestingly, in that article. Another headline, this is from African Leadership magazine, Algeria Western Mining Railway could transform Sahara's economic prospects. And this is by Solomon Obi on January 5th. Algeria has facilitated the completion of full-track installation on the Western Mining Railway, Africa's first heavy-haul desert railway, proving that the nation is taking big steps in ensuring its economic development. The railway, which stretches 575 kilometers through extreme Saharan terrain, is designed to do one thing exceptionally well: move minerals at an industrial scale from the southwest to processing hubs and ports. Built jointly by China Railway Construction Corporation and Algerian state partners, the project was delivered 3 months ahead of schedule, and shows that this was not routine construction, but economic engineering. That is quite something. So, a railway we haven't heard about, the Western Mining Railway. And interestingly, it relates to our previous story. The railway is a pivotal economic diversification project for Algeria, directly countering the nation's dangerous over-reliance on hydrocarbons, which in 2025 still constituted 19% of GDP and a staggering 93% of export earnings. By enabling the large-scale exploitation and export of iron ore from Gara Jabilat, it establishes a new non-hydrocarbon export sector. The project anchors domestic steel production, slashes logistics costs from 35% to 15% of ore value, creates thousands of jobs with specialized training, and supports new industrial zones, thereby fundamentally reshaping Algeria's economic cost structure and future. Scrolling down, this is considered a flagship Belt and Road Initiative project, which leverages Chinese heavy-haul railway expertise and rapid execution. So this is quite interesting. Continuing on, Chinese mining companies in Zambia start paying taxes in yuan. This is Bloomberg News via mining.com. Now, of course, Zambia, at the heart of the copper belt. And now, Chinese mine operators in Zambia can start paying their taxes in Chinese currency. This is Bloomberg News via mining.com on January 2nd. Chinese mine operators in Zambia started paying royalties and taxes in yuan, in Africa's second biggest copper producer, the latest sign of the growing acceptance of the currency on the continent. And it seems like there is a direct competition right now. It seems like China has a conscious goal of enabling its currency to be traded for real-world materials or natural resources. And so we're kind of back to Venezuela, and what is that story really about? It's an interesting question. It's not clear. It doesn't seem to be about drug smuggling. What it is about is an open question. Payments using the Chinese unit began in October, the Bank of Zambia said in reply to emailed questions on Wednesday. The Zambian authorities are the first in Africa to confirm they're accepting mining tax payments in renminbi. Africa is emerging as a key arena in Beijing's efforts to internationalize the yuan, especially in nations that are heavily indebted to it. Kenya this year converted dollar loans it owed to China into yuan-denominated debt. Ethiopia, a member of BRICS, began talks to do the same. And Zambia said it would consider following suit. And we have a quote from the Zambia Central Bank. Quote, a large portion of copper exports go to China, and the Chinese mining firms already receive some, if not all of their payments for their exports to China in renminbi. The Bank of Zambia has the diversification and building up of its reserves as a key objective, and purchasing renminbi enables the bank to actualize this objective. Holding a portion of foreign currency reserves in renminbi will also enable Zambia to service its debt to China in a more cost-effective manner, according to the central bank. And one imagines it's being switched over from the US dollar to renminbi. The bank first introduced rules in 2018 that require mining companies to sell dollars to it to pay royalties. It expanded the regulations in 2020 to cover all mining tax payments, part of efforts to bolster the government's dollar reserves as it struggled with a rapidly rising external debt burden. Mine operators can now choose to sell either dollars or renminbi to the Bank of Zambia in order to make tax payments. The central bank last month began publishing the official renminbi kwacha exchange rate to facilitate the change. Quote, the practical acceptance of renminbi will depend on the Bank of Zambia's reserve management policy, pricing mechanisms, and operational guidance to the market. Joseph Jalassi, senior partner at Denton's local unit, told Bloomberg. Canadian mining companies First Quantum Minerals and Barrick Mining accounted for about 2/3 of Zambia's copper output in 2024. But China's non-ferrous mining and other Chinese operators are spending billions of dollars to boost production of the metal just as it posts its biggest annual price gain since 2009. All very interesting. And finally, very interesting story from rareearthexchanges.com, January 4th. Mining rare earths with microbes. Can this be a cleaner way to extract heavy rare earth elements? And here are some bullet point highlights at the top of the article. First industrial-scale bioleaching trial successfully extracted rare earths from 3,000 tons of ore with 95% recovery in 60 days, achieving 50% higher yields of valuable heavy rare earths compared to conventional ammonium sulfate methods. Microbial bioleaching operated at near neutral pH, resulting in improved soil quality with higher pH organic matter and nitrogen content, while supporting resilient microbial ecosystems instead of causing acidification and contamination. Research by Central South University demonstrates a cleaner alternative to environmentally destructive traditional rare earth mining, offering a viable path for securing critical mineral supply chains without ecosystem damage. Now, that research, interestingly, is all coming out of China, and it is Dr. Jiayu Meng and colleagues, all based in Changsha, the capital of central China's Hunan province. So a big start to the year here with lots of action as usual, and we have a wonderful show, the final in our series from the International Metals Symposium. This is the Super Gold panel, which I'm sure you're going to enjoy. It features Renaud Adams, John McCluskey, and Bob Quartermain. So a final wonderful discussion on the precious metals markets from true experts and insiders in the business. Lots to look forward to. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. Turning to the website, nickel price hits 9-month high as Indonesia plans to cut output. This is Bloomberg News via mining.com on December 30th. Nickel hit the highest price since March after top producer Indonesia flagged plans to cut supply in order to boost prices. Output will be reduced in 2026 to better match demand with supply, said Energy and Minerals Resource Minister Bahil Lahadalia, according to CNBC Indonesia. The Southeast Asian country's production of the metal, which is used in both stainless steel and electric vehicle batteries, has surged this decade to almost 70% of the world's total. Nickel is still among this year's weaker performers on the London Metal Exchange as demand from the battery sector continues to disappoint due to the rise of alternative chemistries. Supply from Indonesia has continued to rise even as prices dragged for much of the year, causing stockpiles in warehouses tracked by the LME to rise rapidly. And here is a related story. Vale Indonesia halts mining activities on delayed approval for 2026 output plan. This is Reuters via mining.com. 3 days later, on January 2nd. Nickel miner PT Vale Indonesia TBK said on Friday it was suspending mining activities in Southeast Asia's largest economy due to delays in the approval of its annual production plan. All miners in resource-rich Indonesia are required to submit an annual production plan known as RKAB for official approval, with the government setting output quotas for the industry. Expectations of a lower output quota in Indonesia, the world's top nickel producer, sent prices soaring towards the end of last year. Vale said it could not carry out mining operations without the RKAB approval. Quote, the company believes that this delay will not disrupt overall operational sustainability and expects that the 2026 RKAB approval can be issued in the near future, it added in a stock exchange filing. Asked about the overall 2026 RKAB issuance for nickel, Deputy Mining Minister Yuliot Tanjung told reporters the approval was, quote, currently being consolidated and declined to give an indication of the quota. Yuliot said on Friday the quota would be adjusted to meet demand from domestic smelters. So the battery metals looking like they're actually having a bit of a resurgence here. As we'll see in this next story, energy storage boom strengthens demand outlook for beaten down lithium. This is Reuters via mining.com on January 4th. A boom in battery storage has bolstered the demand outlook for lithium in 2026, driving hopes for an accelerated turnaround for an industry struggling with oversupply. The lithium market has been grappling with a supply glut since the second half of 2022, with demand failing to keep pace with surging supply fueled by a furious price surge that year ignited by an electric vehicle battery boom. But China's power sector reforms helped to fuel stronger than expected demand for lithium used in batteries for power system storage in the second half of 2025, supporting a cautiously optimistic view of prospects for the new year. The data center building boom in China and globally has also driven growing power storage demand for lithium, said Jinyi Su, a Wuxi-based analyst at consultancy Fubao, adding that rapid growth in lithium demand from energy storage in the second half of 2025 has surpassed expectations. Quote, looking ahead, energy storage is likely to become a game changer for lithium, improving its fundamentals, but too high a price could undermine the economics of energy storage, keeping a lid on prices. End quote. Battery storage systems have emerged as China's most lucrative clean tech export, with nearly $66 billion in sales for the first 10 months of 2025, followed by around $54 billion in EV exports. How fascinating is that? Battery storage is outselling Chinese EVs. 66 billion versus 54 billion. Morgan Stanley forecasts a deficit of 80,000 metric tons of lithium carbonate equivalent in 2026, while UBS estimated a deficit of 22,000 tons compared with an expected surplus of 61,000 tons in 2025. Three other Chinese analysts said they expect a narrower lithium market surplus this year. Global lithium demand will grow by 17 to 30% in 2026, while supply is expected to rise by 19 to 34%, according to a range of forecasts by four analysts who declined to be identified as they are not authorized to speak to media. So, lithium continues to move higher. Continuing on, U.S. awards $2.7 billion worth of orders to boost uranium enrichment. This is Reuters via mining.com on January 5th. The U.S. Energy Department announced on Monday it was awarding orders totaling $2.7 billion to three companies to boost domestic uranium enrichment over the next 10 years in a broader effort to reduce U.S. dependency on Russian supply. And we have a quote from the Secretary of Energy, Chris Wright, who said, quote, today's awards show that this administration is committed to restoring a secure domestic nuclear fuel supply chain capable of producing the nuclear fuels needed to power the reactors of today and the advanced reactors of tomorrow. So, big investments in uranium. Continuing on, Viridis gets support for up to $50 million in funding for Colossus Rare Earth Project. This is Reuters via mining.com. Viridis Mining and Minerals said on Monday that the Australian miner had received a non-binding letter of support from Export Finance Australia for a potential funding of up to $50 million for its Colossus Rare Earth Minerals project in Brazil. Continuing on, Critical Metals expects to close Greenland supply deals in Q1 2026, CEO says. This is Reuters via mining.com. Critical Metals expects to finalize the remaining 25% of offtake agreements for its Tanbreeze rare earth project in Greenland by early 2026 and will be open to an investment from Washington, its top boss told Reuters. CEO Tony Sage said interest from the Middle East, including potential processing partners in Saudi Arabia, Qatar, Bahrain, Oman, and the UAE, reflects efforts by energy-rich states to build rare earth processing capacity, supported by lower power costs and faster permitting than in the US and Europe. The company has also pre-sold 75% of planned output split between the US and Europe and aims to keep supply diversified to limit geopolitical risk, Sage said. And over in the Sahel, suspected jihadists attack Mali's Marilla mine. That's Reuters via mining.com. Suspected jihadists attacked the Marilla gold mine in Mali on the weekend, Burning equipment and taking 7 employees hostage before releasing them, an official from the mining ministry told Reuters on Monday. The attack highlights mounting security risks in Mali, Africa's third-largest gold producer, which is battling al-Qaeda-linked jihadists that have targeted economic assets and foreign investment. Armed men on Saturday attacked the mine for which U.S.-based Flagship Gold signed an investment agreement last year, a spokesperson for Mali's mines ministry and another person familiar with the matter said. They burned equipment and took 7 employees hostage, but released them all the following evening, the people said. And finally, just a headline, Botswana to open embassy in Moscow, open up to Russia in rare earths and diamonds. And that is Reuters, and you can read the whole story on mining.com. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.18%. That is 0.06% higher than last week. The UK 10-year gilt is yielding 4.52%. That is 0.02% higher than last week. Italy's 10-year bond is yielding 3.53%. That is 0.05% higher than last week. France's 10-year bond is yielding 3.58%. That is 0.04% higher than last week. Germany's 10-year Bund is yielding 2.87%. That is 0.03% higher than last week. And once again, the big standout is Japan's 10-year bond, which continues its relentless climb. It is now yielding 2.13%. That is 0.06% higher on the week. And finally, China's 10-year bond is yielding 1.88%. That is 0.01% higher on the week. One wonders if yields are going up because of the actions in Venezuela and the uncertainty around it. Continuing to precious metals, gold is trading at $4,478.40 per ounce. That is $103 higher than last week. Silver is trading at $78.25 per ounce. That is $4.42 higher than last week. Platinum is trading at $2,267.70 per ounce. That is $165 higher than last week. And palladium is trading at $1,742.50 per ounce. That is $84 higher than last week. So precious metals recover nicely from the drawdowns last week. Turning to industrial metals, copper is trading at $5.93 per pound. That is 43 cents higher than last week. Iron ore is trading at $106.99 per metric ton. That is 7 cents higher than last week. Aluminum is also higher at $1.40 per pound. That is 6 cents higher than last week. Lead is trading at 92 cents per pound. That is a penny higher than last week. Nickel is also higher at $7.84 per pound. That is 70 cents higher than last week, so up almost 10% on the week. Tin is trading at $18.33 per pound. That is $1.09 lower than last week. Cobalt is trading at $24.20 per pound. That is 25 cents higher than last week. Lithium is trading at $17.11 per kilogram. That is 27 cents higher than last week and continuing its relentless climb there as well. Uranium is slightly higher at $81.65 per pound. That is 25 cents higher than last week. And zinc is at $1.46 per pound. That is 6 cents higher than last week. As we were seeing in the articles, we are seeing a widespread rally in the metals, with copper, nickel, and lithium perhaps turning the most heads. And you wonder if it's going to be a feedback loop with investors seeing what's happening in the metals markets and then that increasing their interest in these markets. And those are your metal prices. Coming up, I'm very pleased to present our final panel from the International Metals Symposium held in London. This is the Super Gold panel, and it features 3 prominent personalities who have worked at the top of many prominent mining companies in the gold community. It features Bob Quartermain, John McCluskey, and Renaud Adams, and it is moderated by Northern Miner Group President Anthony Vaccaro. I hope you enjoy the discussion, and I will see you on the other side.
We've all survived a bit of a harrowing decade there from 2012, and now these are the times we get to enjoy and get to learn from your guys' insight. You all weathered it very, very well and have come out as stronger than ever. So I think, why not start with the obvious? What has been going on with the gold price? What do you think is going to happen from here? What are analogs? You all have esteemed careers. You've all been in the sector for a very long time. We can learn from what you have seen. Why don't we start with John over there? John, your macro picture for gold. What's been the key drivers in your mind? Is there an analogous period? Where do we conceivably go from here?
Other than saying the obvious, which is, gold is cyclical. And, over the last 40 years or so, I've been in this sector. That's what we've watched. No two cycles are exactly the same. And this one is about as unusual a cat as I've ever observed. I mean, first of all, it was driven by central bank buying. And anybody who was around long enough to remember what it was like in the 1990s, central banks couldn't sell their gold fast enough. And certain banks, like the Bank of England and the Bank of Canada, they virtually dumped all their gold. And to this day, Canada barely owns an ounce or two of gold. So, I mean, it's a unbelievable change when the central banks are the driver of the gold price. And to this day, we really haven't seen the typical players that drive the gold price get to work, get into the market and start to buy. If you talk to fund managers, and we talked to quite a few of them, and they're really not seeing, except in exceptional cases, they're not seeing the inflows that would typically be seen in a big run-up in the gold market. In other words, retail investors are still very much focused on the S&P 500, those top 10 tech stocks that have been driving value creation for 10 or 15 years now. That's continued to be the story. So I think that wave is still to come. And from that perspective, I would say we're still in the very, very early days of this gold market. And as dramatic as it is to say, I mean, for gold is no longer, it's not a top by any stretch. I think we've got a long, long way to go. And we've seen another phenomenon this time around with the rise of cryptocurrencies, Bitcoin and so forth. Bitcoin was, a bit of a joke. People were throwing their computers away with, literally tens, if not hundreds of millions of dollars of Bitcoin inside. And it was a few years later, it wasn't worth pennies, it was worth $100,000. And that has been, if you want, a bit of a deflection from the speculative money, you might say, that would have typically gone into something like gold. And I think it's been a really sad distraction because, people have been playing around in something that's really ephemeral. It has, from what I can see, no real intrinsic value. And while, speculators have been diverted into this fantasy land of speculative investment, I think the real accumulators of a real commodity like gold have been the banks, and particularly banks like China. So I think in a big respect, they've benefited from that because if you want to accumulate enough gold to back your currency, you want to be able to accumulate as much as you can as at low a price as you can. And without speculators in the market, if they've been diverted towards cryptocurrency, so much the better. And I think that's been a really remarkable phenomenon of what's been going on in the market this time around.
Excellent. Great insight. And I started the day showing a chart from 2018, which is when Russia sold off almost all of its U.S. treasuries. And lo and behold, gold started kind of going from there. So to your point about central banks. And the nice thing too, I think, with central banks, a little bit more price insensitive to the actual price of gold. If they have a strategic interest in buying gold, maybe 4,000 doesn't deter them as much. Renaud, what do you think in terms of, let's bring in the question of de-dollarization. Is what's at play here is a move away from the USD?
I think this is really the driving force, right? I mean, there's always been inflation, but one thing has never really changed. Even if you go back in the decade of 2007, there was always a perfect correlation between the gold spot price and what we call like the real rate, right? The treasury real rate. But to your point, in 2018 was the start of the selling off of the U.S. and replacing by gold and the precious metal. But in May 22, it really took off. right? And it's not just Russia. It's like all emerging markets, central banks. And for the first time in 2025, you have to go back to the gold standard time, where gold is officially now at the 27% or so, close to the 30% of the portfolio, right? If you look at the treasuries and US is below. And this is the new driving force. And this is not something you turn back overnight. This is like a strategic, clearly a strategic approach, for emerging markets. So this is really what I think is the driving force. This is no longer, and it's a complete decouples of the real rates. It's not even like close, it's completely decoupled. And if we want to put this in perspective a little bit, back at the time of the gold standard, the Nixons and the taking off, the U.S. from the dollars, from the gold standards, there was about 40%. So you could argue, there's still some room here, from expecting obviously others to join the melting pot here, and maybe other currency and so forth. Silver, we're definitely, we're seeing it. But I think we're assisting now since 22, but more even so now, in a complete different model. And we're completely decoupled for any models we've followed before. And again, you could go back in the last 10 years and you would read like all kind of crystal ball, where's the gold going and so forth. But at the end, it was still very much coupled, with the real rates. Yep. And now it's no longer. So I think that's the driving force. I think we're a complete different market. And it's up to us to catch the wave.
Excellent. We all remember probably Rob McEwen 10 years ago saying gold was going to go to 4,000. And maybe you believed it, but a lot of people were skeptical at the time. Here we are at 4,000. And in John's estimation and Renaud's, we could go a little bit higher from here. Bob, bring you into this conversation. Do you agree with what is driving it, and how much juice is left in this price push?
No, I think both the panelists have been very focused in what's certainly driving it. And I would concur when you go back to the start of Bretton Woods, and look at global economies. I mean, at that point in time, the U.S. was 240 billion GDP versus the global economy at $1 trillion. Now we're 100 trillion. The U.S. makes up, a third of that. You add in Europe, you're looking at 50 trillion. And so we've had this incredible increase in wealth going forward. And the point, I think gold certainly is reflected within that. And I've been in this business, like the other gentlemen, since 1977 when gold was 140. And I have no reason to sell it, right? I continue to focus gold and exploration because, I concur that it's going much higher. And to John's point, we certainly have had this curve going along where it's been fluctuating, but I think there's been this disconnect now. And what we really need is to get individuals back in the space. Central bank has been certainly pushing the gold price higher. And again, we still have a lot of very focused retail investors, but I think, Bitcoin has taken some of that risk away. But once individuals see that this $4,000 is again a base and we're going to continue to work off of it, then I think it's just going to be good for us in the industry because it's going to bring more players back into it. So I remain bullish on the commodity. It's certainly been very helpful for me throughout my career.
Well, and Renaud mentioned silver. Earlier in your career, silver standards. I mean, do you still have a place in your heart for silver? Do you follow that market? Do you have an opinion on how silver factors in?
No, very much so. I mean, the project I'm currently working on in South Dakota, we've got a nice silver credit going along with our gold. So for sure, I mean, more industrial, and we're certainly seeing those applications going forward. But yes, I mean, the gold is just a much larger, more liquid market than the silver has been. And so we've seen fluctuations in it where the gold to silver ratio has been 30 when silver's been high and up 120. It averages over the last 40 years at around 80, kind of currently where we are. But again, there's certainly a cohort in the space of silver investors who are going to continue to focus on it. And at some point, we will always see it fluctuate, perhaps more than gold in that regard. But no, certainly dear to my heart as well. Yep.
Okay, excellent stuff. With great success comes new challenges. I guess it's the condition of being human beings. We're never without our challenges. You've had great success. Cash flows are very, very strong. Perhaps one of the challenges, how do you approach capital allocation when you're in this situation that we're in? We're going to again start with you, John. I mean, strategically, corporately, what's right for the company, we definitely want to hear. How are you going to continue to keep this going? But also, if you can fold in what you're hearing from investors, are they wanting more dividends, share repurchases?
I can't recall meeting an investor that doesn't want more dividends.
That one's pretty simple.
I would count myself among those. For every company, it's going to be somewhat different. And, you've got quite a range of companies in the gold space, from the small exploration developers to the mid-tier group, the majors. And it's going to be different for all those companies. I mean, the nice thing about the developers is they're finally catching a bid and they can raise some money and start to build value. the good old-fashioned way, drilling and permitting and so forth. For a mid-tier company like mine, we're, by and large, we're a growth company. How much of a growth company? Well, 20 years ago, we had no production. Today, with that no production, we had a market capitalization less than 15 million Canadian dollars. Today, we're producing just under 600,000 ounces of gold and approaching a $20 billion market cap. We have the wherewithal through expanding our existing production profile, in other words, through expansions of assets that we already operate. We can take production up over 1 million ounces over the next 4 years. So we're focusing the capital that it takes to achieve that on investing in the infrastructure that will take us there. So that's primarily what we're doing. A big component of that is exploration. We've always been very focused on exploration, maybe because we started as a small exploration company. We were one of the last companies to list on the Vancouver Stock Exchange. I think we did a $2 million IPO. And the whole idea was to get into Mexico and see what we could do. And, by now we've produced close to 4 million ounces in Mexico from the Mulatos project, and lots of production still to come. But we've sustained that project through drilling. We started out with 6 years of reserves, and we've been mining there for 19 years now, and we can still see another decade out in front of us. Similarly, with the assets that we acquired in Canada, they were all very small when we acquired them, and we acquired them at the bottom of the cycle. Between 2015 and 2017, we did back-to-back acquisitions when gold was trading between $1,100 and $1,300 an ounce. It's one thing to say, well, I believe in the gold price and I'm convicted, but we did $2 billion worth of acquisitions when gold was at the bottom of the chart. And very few investors liked what we were doing. That's just a reality. But those same assets are the projects which have driven our valuation and growth. Buying them at the right time, buying them cheap, and then investing the money through drilling and development, we've turned those into world-class assets. And that, to me, is it's kind of the name of the game if you're a mid-tier company, how to build value. Agnico and companies like that, they were the ones who did it the last cycle. Now they're the major mining companies. And this cycle is the one where companies like Alamos that were, microcap explorer developers in the early 2000s, now we're the companies that are emerging into the major ranks. And, that would go for my colleagues on this panel that we've all built companies from very small beginnings. And it's a fabulous business. It's a very risky one. Very few people succeed in it, let alone succeed multiple times. That's what I think keeps investors kind of focused on this part of the sector. They're not just coming to the gold space to get some exposure to gold. You just buy the 4 or 5 majors if that's all you wanted. But if you really wanted to tap into something really exciting, the companies that are, put it this way, we're the companies that will buy the Colt with the idea that we think we can spot the next Triple Crown winner. Right. Whereas the majors, they're just trying to buy a Triple Crown winner and turn it into a stud, right? That's the difference. And I love this part of the business that we're in. And if you're good at it, it's amazing how much wealth you can build for your shareholders.
Well, yeah, you're all examples of that. That is for sure. Renaud, I'm going to tweak it a little bit for you. I mean, your calling card in many ways in this sector is you're the guy that comes in there and really understands operations and how to drive these things. You did it at Richmond. You're doing it at IAMGOLD. It's been a noticeable change since you've taken the helm there. I don't imagine you can do that without a strict eye on cost. And we know in the last bull run, that was one of the things, right? The cost, sure, we had this big, nice push up in gold price, but oil was really going up high as well, and margins were getting a bit crimped. Give us your view on what's happening this time around, with a bit of a focus on cost. How is that working itself through your financial statements?
Maybe just as well, if you step back, we have to remember that back in time, that time that you said we missed a bit, the last ride transformed this industry into a higher cost to a certain degree. And it goes back to what we just talked about, the movement of the gold, and so forth. Back in time, there was no new reality of gold. It was still, like perfectly coupled. We maybe rolled the dice a little bit, but we really created an industry where it was okay to have those average 1 gram type of, and when we were building those big assets and so forth. But eventually, if we would have just followed the tendency of the cost, it was written on the wall that he would catch up, right? Yeah. Now I think this time around is a complete different phenomena happening. I think everyone will really work hard, and focusing on their cost. And it's the time. The way we look at it, we're up to 40 million ounces now in Canada. This is a significant shift from 10 years ago where all the business was overseas. This is our opportunity. And our focus on the cash flow generations will be definitely to put those ounces at work. We're not going to design an industry that works only at 4,000 ounces. We're going to work an industry that works at current cost, maybe up to $2,000, maintaining significant margin for us. Rewarding shareholders is absolutely part of the deal here. I was with this company 10 years ago when the production profile is about the same as today, but with 200 million shares less. So there's no doubt in our mind that before you think dividend, there is a significant opportunity here to readjust the share count of this as was a vision back in time. But I see it different this time. I think in the last cycle, even the investors I remember those conversations why you don't have one of those assets. This time, this industry is created. The 40 million ounces we have are part of this cycle. Yeah. We haven't changed anything. We're not going to change anything. We're just going to prolong this at the higher gold price. So we continue to design this company, using the current kind of cost structure type of, same kind of grade, the typical open pitable 0.9 to 1.4 grams a ton Canadian style deposit. Our resources and reserve in the future on the grounds are all high grade, from the Westwood to the Monster Lake and the Nelligan. So we're not going to change this. We're going to just continue to design, build, execute on the current cycle of what is the cost structure, but we're going to be part of a complete new reality in the gold price. That's going to give us a chance to return to the fundamental that we used to call you buy with share and you build with cash. What we did in the last 10 years, we did both with shares, right? So we need to change this. I think we understood, and this is the opportunity, and this is what we're going to do.
Well, it's a compelling story, and it's one that the market is responding to because we're seeing it in the revaluations of all three of your companies have very strong revaluations. It's been an incredible year for all of yours. Bringing it over to Bob, though, very often we see that when the gold price goes up, the producers are the first to participate, and then that next level is the developers. And you seem very well positioned. You're in one of the most sought-after mining jurisdictions historically with Homestake. Dakota Gold's shares have already gone on one heck of a run. But talk to us a little bit, as a developer, what is the right mix in terms of financing so that you can most wholesomely participate in what should be another leg of investment for developers?
Right. It's interesting. Over my career, I started it with the development of the Hemel Gold Mine 40 years ago when I started it. And when we look at the opportunities for developers now, the access to quite a cash distribution where we have not only royalty streamers as well as private equity money, it provides us with a lot more opportunity to manage share count, which is important for us to do as an owner of the business. And that's what I like about being in the jurisdiction where we are. We're in private land, and so therefore that can attract a certain level of capital because you've got a little more security with respect to your permitting timelines that you would see. So those of us in the development space that, yes, we're benefiting from the gold price, but certainly haven't benefited to the extent that the producers have to this point in time. But I like this space. It's where I've been comfortable throughout my career. And what I'm enjoying is you can find shareholders who will participate with you depending upon where you are, let's say at the feasibility level, who may be different than we are kind of at the PEA level as they kind of watch what you're doing. But key to that is we have a silver component. So this aspect of accessing maybe a silver stream from what we're able to do can help us along our development pipeline. So I like this stage of where I'm in my career with this asset from the fact that there's just much more optionality that we can have to be able to finance it to go forward other than just doing conventional shares out and dilution down in that regard. And it allows you through vendor financing and being in a jurisdiction where we are, where we're just, 2 miles away from an existing mine, that people look at us a little differently. Not only is this kind of a, greenfields or brownfields development opportunity, because there's an existing operation nearby, then it brings other vendor financing for us that we might not have in a project like, let's say, Bruce Jack. And so by having proximity in an historic mining camp, certainly creates different financing opportunities for us in this development phase that is going to help us advance the project.
Okay, excellent. Thank you. It goes way too fast when we have a panel like this. Let's go. Everyone can jump in on this one. Thoughts on M&A? Where are we? Is it accelerating? Are we in danger of tipping back into the acquisition at any cost?
Well, I must say that just because of what I said before, what is different now is the ability for company to build, using cash flow generations and so forth. So I could see juniors continue to be acquired, especially company with maybe not totally the pipeline they wanted to. And now it's very well positioned to do this. It's kind of difficult maybe in the intermediate level. You may want to acquire cash flow, because you have the pipeline, but you don't have yet the cash flow and so forth. I bet more on the junior continuing to be acquired in a cycle where companies change their production profile without printing shares. I think this one will continue definitely. But intermediate been acquired, yeah, maybe there's some things we could see here, but I bet more on the junior.
Okay, John, let's get your input on that.
I think a lot of the value destruction that occurred could be laid at the feet of investors. They never want to take responsibility for that. But I remember what was going on. Those same institutions that were pounding the table, telling the major mining companies to go out and make acquisitions were the ones that complained the most and pointed the fingers at the CEOs for having made those deals that they demanded. Right. And that's the way it goes. Investors want to hear about M&A when the gold price starts to run. That's the wrong time to do M&A. Right. It's when it goes the other way. And if you look at the track record of my company for the last 20 odd years, 25 years or so, we've been buying assets when the gold price is at the weakest point. That makes perfect sense in a cyclical business. But is there an M&A opportunity now? That's got to be on everybody's mind. Well, first of all, I think gold prices are going to go a lot higher. So you could argue that you're still in the early innings of this market. And so from that perspective, it probably still makes sense. Is it as good as when gold was down at $1,300 an ounce? Definitely not, right? First of all, there's a lot more competition. Did you face any competition for your acquisition of Hemlo? Probably. Of course, a lot more competition on every asset. That's going to drive the cost higher. And, even when it comes to mergers, if you're looking at something, say a producing mine, a producing company, 18 months ago, my guess is they're trading at less than half of where they're trading today. So you're ultimately going to pay a lot more money. And so the risk is higher. And we can't predict what's the timeline and the way this cycle is going to unfold. So would I argue that this is, a good time for Alamos to do M&A? And my perspective is no. We were very aggressive when gold prices were a lot weaker. The one exception was, and there's always an exception, we acquired a company last year called Argonaut Gold. They had a 4 million ounce deposit right on the doorstep of our Island Gold mine. They were running out of money. They had to do something. Nobody else could really afford to buy it. It had to be us. Even though the gold price had gone up, they'd come from basically $4 a share down to 22 cents a share. So we made an exception, and we bought the asset on pretty good terms. I do think those kind of deals will happen. And all the companies that have the strong balance sheets and who have very opportunistic and entrepreneurial driven management, those companies will know when to jump on good assets. So I still think you'll see some interesting deals. I think from the majors' perspective, the majors are the ones that are depleting their resources the quickest, and they tend to be depleting their best mines faster than other things they own. And so from that perspective, the pressure's more on their shoulders than, say, on the mid-tier group. The mid-tiers, like in our case, every year that goes by, our reserves are growing. So net of depletion, all our projects are getting bigger. That's a great position to be in. Not every company's in that position. But I would say that we don't do M&A because we have to do M&A, because we're being chased by that bear of depleting resources. And from the junior side of the equation, I think this is there's still a great opportunity now, because again, another sort of anomaly that was driven by investors last cycle. What they were doing is they were selling producing companies and they were buying the developers and then forcing the producers in these meetings to make those acquisitions. I've experienced it myself. I had some of my biggest investors in Alamos back in 2018, 2019, when Argonaut was trading near the top of its chart, telling me I should buy it. Then I go check the share register and find out Well, they're big shareholders of Argonaut. No wonder they want me to buy it. So, you can't deny that goes on. That's been my experience. But we are going to sort of see a bunch of interesting deals. The best of the developers are going to see interest from mid-tiers and majors. And I'd say there's an exciting M&A market coming up for that group.
Fantastic. You notice how John expertly actually answered both of my questions in one. So very good. Did you want to say it?
I just wanted to say discipline. And that's what we're seeing in this cycle from the last one, right? When I look at myself, our cohort here, Clive there, and this group of cohort here, who are exploration and developers, we're really being good with shareholder money, which we need to be able to feed that pipeline. And I think what the last cycle taught us, when there wasn't access to capital, we need to be really good at it. And so what I've listened to some of the presenters today and see the individuals who are attending your conference, we see that discipline in our side of the business in doing the exploration, going up that development chain, and that creates the opportunities for these individuals to get quality projects, which they may want to add to their process. So that's what the last gold cycle taught me, and I think many, is just discipline with capital to ensure you spend it the right way.
What a perfect note to end on. Fantastic job, gentlemen. Thank you so much.
Thank you once again to the Super Gold panel, John McCluskey, Bob Quartermain, and Renaud Adams, and also Anthony Vaccaro for an excellent discussion in London for this week's episode. And thank you, dear listener. I wish you all the best in this new year. And thank you for supporting the show. I hope you're enjoying it. And thank you once again for the messages. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.